Now, before we get into the Chinese Communist Congress, where we wanted to touch on some other components first, specifically Australia, India, just because it's going to be a bigger piece of when we start talking about China and what's happening with Australia. But the RBA didn't take long to panic now that they came in and they bought 4 billion Australian dollars of longer dated bonds, or double the expected amount. So that was when, as we've been saying throughout the different episodes, this was an aim to maintain that yield curve control, because they went out and immediately tried to take some of that, shave that off. But the 10-year bond now, while it fell 26.7 basis points from the high, it has now started to grind back up as we're starting to see some of this pressure come back in, and the U.S. really kind of leading the charge as the rates continue to go up. Now, the Beige Book came out, and we'll do more on this next week, but when we look at what they're saying, the biggest issue is the labor market recovery continues, but at a very slow, sluggish pace, which I think is, again, as we've been saying before, is not just a U.S. problem, but a global problem when we're seeing a lot of these issues with unemployment and the employment benefits and just activity in general. So then when we take and look at India overall, so you can see GDP came in a little bit lighter than expected, and this is kind of what we were saying, just based on looking at some of the issues that continued to arise from the export-import side. Now, things are starting to get better, so this is not something that will last. It's just the question is how quickly will we see that pivot up, because things still look a little bit sluggish, especially when we weigh imports versus exports, because imports increased, exports declined. Now, the increase in imports does indicate that exports will start to see that bounce up, but this is where we're starting to see some of this bifurcation. Now, the PMI number for India came in just right around the prior, which is a net positive because it's still expansionary. We're still seeing manufacturing come back, which will point to an increase in exports over the near term, which I think is something that should be expected going forward. Now, when we look at India and Russia policy rates, the reason why we're looking at this is just talking about those inflation expectations. So when we look at what the market is kind of expecting in general, there's that bifurcation of the inflation rates, because inflation is going to be a big part of how much can India and Russia really continue to ease and provide support. And India's in this, some of the data is getting a little bit worse for inflation, and others are holding firmly within the spread that the central bank laid out. Now, the problem is, as import prices go up, as we see commodity prices going up, that is going to weigh on some of the inflation expectations, and they need to see some of that adjust, which is why gasoline, diesel prices will be so important, because depending on the province that you're in, the price of petrol can be anywhere from 53% to 70% dictated by taxes. So you could see some tax revenue come down, or at least seeing some adjustments at the feedstock level to try to bring some of those prices under control. But when we look at just the inflection point, so the infection caseload in some parts of the country is getting better, but however, again, is creeping up in others. The Reserve Bank of India Governor Das said Thursday, and the thing is they're looking to stay vigilant and try to make sure that they're not opening too fast, and that some of the provinces that are seeing an increase are limiting a certain amount of movements to protect against that spread. But while all of that is happening, we're now back to a net positive increase on the Indian economy. Now, this is something where it's still fragile, and there's still, we saw a little bit of a slippage down below zero, but the momentum is now back to the positive side, where China has a bit more of a momentum to the downside. So the question is going to be, how does this kind of weigh itself out in the Asian markets? And when we look at some of the data points coming from the World Bank, and this is just looking at, worldeconomics.com, you can see that the sales manager index, and this is where I remain concerned, you're seeing it flatline. Now, this is going to look at what are the managers seeing, what are they expecting, and this will be very indicative to how quickly will people be employed, how quickly will people get jobs. And this is, these headwinds remain, the slowdown in employment will be felt, and it's being pushed on the profit margins index. So margins are getting compressed, speaking to higher prices paid, lower prices received. So if the margins are getting impacted, then you'll have less money to hire people with, which is going to be that overarching issue for the sales managers, and how willing are they going to hire. Now, the staffing levels index has turned positive, but it's still negative. So this is where now the leading indicators are starting to turn negative. They're starting to put pressure. So even though we had this positive turn, I don't think it's going to come back down just because the manufacturing PMI is stronger. You're starting to see that positive momentum in other parts of the economy. It's just going to flatline. So instead of getting back to expansion, you're just going to see kind of a gradual leveling off at these levels, which is going to impact just how quickly do we see gasoline recovery, how quickly do we see diesel recovery, and just how quickly do we see general Indian economic growth, which I think will be strong, but not at the level that is expected or estimated in the market. Now let's take this and let's look at some of the different factors as we go into South Korea. So when we look at South Korea, exports came in a little bit below estimates. Imports came in a little bit below estimates, but both of them are still positive and going in the right direction. Industrial production was up 7.5%. Industrial production slowed a little bit month over month, but year over year, moving in the right direction. And PMI came in at 55.3 from the previous 53.2. So a positive move, and the imports is still showing that exports will be supported. So this is still a net bullish backdrop for South Korea. They're facing some local consumption issues just with a little bit of an increase in COVID, restrictions remaining across the populace, but still a positive momentum. India, this is something very similar where PMI services, had that bounce from 52.8 to 55.3, and the composite still remains in the growth projection. The problem is some of that PMI is from obviously inflationary issues, which would impact India more than, say, a US, just given their sensitivity to inflation, the fact that they already have a 4.5% inflation rate. And if we started to see that get out of that range of 5.5%, you'll start to see some adjustments. Now, I think you're already seeing it. The monetary policy has slowed, and that's to give way to fiscal and to try to tamper down some of those issues. But regardless, commodity prices are going up. Now, India is also a seller of commodities, so there's a benefit to that. It's just they're still importing more than exporting, which is going to be a detriment when we're thinking about those import numbers. Now, when we go through the rest of Asia Pacific, looking at that PMI level, Vietnam remains the growth story. Taiwan remains the growth story. The bullish side remains intact for Vietnam, Taiwan, South Korea, but the rest of Asia is slowing or is kind of held in place, which is why we're seeing this separation of how much activity is really coming into the market, especially the Asian market. Then when we look at just foreign trade in general, we just want to look at, okay, well, what is happening across merchandise April through January? This is looking at Indian numbers. So merchandise April through Jan, exports were down about 13.6%. Imports were down 26%. Trade deficit was a positive 72. Then services on the April side, you had exports that were down 6%, imports that were down 11%. So it's a positive move. But then, as we were talking earlier, it's flipped. So this is looking up through January, and then February has gone the opposite way, where imports outpaced exports, but it's still a net positive in general, because when we look at overall, marrying it all together, exports were down 11%, April 2020 to January 2021. Imports were down 23%, but we're starting to see that turn, which is a positive on the import side, because as imports come through, that means that we're going to see more on the export side. It's just that's also going to be an inflationary issue. So these are going to be things to watch in India in general. And that's why when we look at trade, this is looking at the year over year. So India merchandise imports year over year came down and exports started to turn back up. So imports continued to recover, which again points to a growth in the export story, which is why when we now turn to China, we're starting to see a slowdown in China. Now, China, if we look at the manufacturing PMI advanced 3 months and the index, this is why we think we're going to see that pressure to the downside. And we've already started to see it in trade, as we talked about in previous segments, where trade was really starting to tamper down as their ability to compete, as their ability to subsidize some of these exports started to get weighed down just based on rising costs that they just couldn't eat anymore and had to start passing through to the consumer. So when we look at just the general level of activity, the non-manufacturing PMI was supposed to be at 52, came in at 51.4. Manufacturing was supposed to be at 51, came in at 50.6. Again, just barely in the expansionary level. Composite PMI at 51.6. But then when we look at the Caxton level, they came in at 50.9 on the manufacturing, 51.7 on the composite, and then in line on the service side of 51.5. So it's still expansionary, but it's cooling, and you're starting. And given we also have to believe what they're saying, but this is also picking up Lunar New Year. So the Lunar New Year was very slow based on what we know, but a slow Lunar New Year is giving a separation in data points, because the consumer seems to have been very strong, but exports are slowing. So are we starting to see the benefit of consumption locally as the pressure continues to mount on their exports as people go elsewhere or look to diversify some of their supply chains? And now, just as a reminder, because we're going to start going through some of the components, the National People's Congress, it starts March 5th. Beijing, and this will be the second straight year that it's mostly virtual. But this is what we're going to, so we talked a lot about it last week. We're going to talk about it again this week, and then we'll talk about what does it mean going forward over the next 5 years, this year in terms of trajectory, projections, and this is where we're going to start to talk a bit more about it. Now, it's important to appreciate, coming back to what we're saying with the PMI. At a press conference on Monday, the Minister of Transportation, Li Xiaoping, revealed that the country had gone on a bit of an online spending spree. 660 million packages were delivered during the holiday period, which is a 260% increase. Now, what does that mean in terms of where it is in general? Because the headline data from the holiday, so the headline data showed a decline of, or a subpar growth of 5% consumption year over year. But under the hood, the numbers are kind of moving everywhere. So e-commerce was up 260%. So this could be that people were like, look, I'm not leaving, I'm staying home, but I'm not shopping. So I'm not going to the restaurant, I'm not going to, out to see people. We did see people go to the movies, so there was that increase. But in terms of just general activity, it was down, but people were actually spending. So this year, central and local governments discouraged that travel, as we've talked about in general. And this had a decline of 45% year over year, which, if you think about year over year, I was thinking that we were going to be closer to where we were last year. Clearly, there was, the lockdown came after Lunar New Year, or the stricter lockdowns came after Lunar New Year. So this is why there was a bigger impact on the demand side of both crude and refined products. So holiday spending at key retail and dining venues reached 821 billion renminbi, a nearly 30% increase from 2020. Again, people stayed local, so did more local. So it's going to be interesting to see what does this look like on a go-forward level, because at the same time, when we start thinking about what are some of the backdrops? Now, as we keep talking about, that's going to feed into services, that's going to feed into some positive data on the consumption side. But then when we go abroad and we think about what the U.S. has said and what the symposium is going to start talking about, so we start to get some early indicators. So symposium attendees were united in their support of the following concept. Attendees, and this is, again, ahead of the official Congress, attendees said the effective implementation of patriots governing Hong Kong is a prerequisite for the full and faithful implementation of the one country, two system principle. Measures must also be taken in terms of stepping up the selection of governing personnel. So simply, they're just saying that if you want independence, or if you are of the mind that China is not, Hong Kong should be independent, you're never going to be able to run. So according to Trivium, which I think sums it up well, the symposium is almost certainly a prelude to some sort of electoral reform in the upcoming National People's Congress. It looks like Beijing is preparing to neuter Hong Kong's feisty opposition parties. So if you think about the conversations that President Xi has had with foreign leaders and what the U.S. has been saying to try to drum up allied support against China, they keep coming up that in order to be friends with China, you have to say that give them free rein to do what they see fit in Hong Kong, Tibet, Xinjiang, and the U.S. is taking the opposite approach. And these are where these two areas continue to clash, specifically in Hong Kong, but Taiwan is where the line in the sand really stands. And that's why when we're reviewing the 14th five-year plan and the government work report, or the GWR, we have to understand, what does it mean when we're thinking about the forward look on PMI, the forward look on trade? What are they going to come out with? Because we've talked a lot about this last week. So the government work report will persist in our strategy to expand domestic demand. That is the view. Remember, dual circulation strategy. This has been talked a lot about, expanding domestic demand over the past year, but what does it mean? What are they going to try to do in general? So the question of how to sustain an expansive social safety net to adequately cover China's huge and aging population, as we talked about last week, is coming to the forefront. So 2 points from the presser stood out in terms of how the government plans to retool its innovation policies over the next 5 years. Now, this is going to try to hit on growth of the economy, dual circulation, more domestic growth, and this aging population. Policymakers will look to implement a list and commandeer system whereby the government pushes a list of core scientific projects and solicits help from researchers on a voluntary basis, trying to increase investment from the government into key projects. They will also look to develop policy instruments to more efficiently select and allocate funding to potentially groundbreaking research projects. But the problem remains, how do you incentivize someone if you're not giving them IP or payment in total? So again, this is something that's going to have to be talked about, which is why the re-education programs are going to be so vital as we go through the remainder of this period. So just some more context on what is happening on the demographic side. The population is aging and the number of newborns continued to fall. 2020 dropped 14.9% from the 2019 levels. And what are they going to do to try to increase this birth rate? Now, these are things that are going to be talked about in this upcoming Congress. Extending maternity leave to 6 months and guaranteeing fathers' paternity leave, making child care costs an income tax deduction, subsidizing education costs for the second child. This is something that hasn't really come in yet, and right now you don't get that for the third. Policy support for households seeking bigger houses for growing families, subsidies and tax breaks for employers that retain jobs for pregnant mothers. Another party, the CCP, signaled that policymakers should find ways to encourage babies, and in terms of this was something that was talked about in October in general. So then when we turn around and we say, okay, well, all of this has to happen, but what is happening with credit impulses? What is happening in general when we look at the 10-year yield and the 10-month lead that is coming into the market as we continue to see rates go up, as inflation starts to become a bigger problem? And when you think about what the PBOC has said of trying to cool down some of the market and take some of this liquidity out of the system. And that's why we think the credit impulses, based on the chart that's highlighted here, will continue to start to come down because they just need to normalize a bit more as higher yields point to lower credit impulse. Now, what does that mean? How can we classify that? So the recent or the old finance minister, who was there from till about 2017, Goy updated everyone on the progress of the financial de-risking campaign. Now, when we think about what does that mean, so what are we going to do here? So bank assets growth clocked in at an average of 8.3% between 2017 and 2020. Insurance assets grew by an average of 11.4% over that period, which is about half of the average growth in both sectors from 2009 to 2016. So they're still putting in growth assets, but they're trying to shrink the amount. Banks wrote off 8.8 trillion renminbi in non-performing loans between 2017 and 2020, which far exceeded those write-offs, as they're trying to normalize their balance sheets, recognize the fact that they need to take some of this bad debt off the sheets, and try to show what is their actual strength and what is their support that they're going to get over the near term. Now, we've seen the talk about shadow banks. Shadow banks have started to come down, but they're starting to get a bit more activity again, just because as they're showing a slowdown in credit impulses, they might panic and just push more through. But this is where we continue to see some of this backdrop of the scale of shadow banking has decreased by 20 trillion renminbi since the high of 2017, but we've actually started to see that creep higher from the end of 2020 into 2021. But property mortgage growth was slower than other loan growth for the first time in 8 years, which is a bigger conundrum, which we'll talk about in a second. And then illegal financial groups have been brought under control, but they're starting to find other ways into the market. And then they're growing. The growth of implicit local government debt is starting to get more under control, but it depends on which province we're talking about, because there's also a role that has to happen that is going to keep some of this elevated. Trust companies have ramped up lending to local government financing vehicles by teaming up with local financial asset exchanges in a bid to avoid or evade oversight. So again, finding new means into the system. China's trust companies have a reputation of financial innovation, but the regulators are trying to rein this in. But again, they're struggling to find ways to do it because they also need some support. And that's why right now the Chinese financial system is kind of drifting in terms of they're finding regulatory and legal loopholes. So even though they're clamping down here, they're finding loopholes to maintain the system, which is why the regulators are continuing to find new ways to manage. And this is when we look at China's real estate loans, you can see that this is where a big bubble still remains, and there's an overhang in the system that has to be mitigated and managed, because the bubble has been really propagated since 2016 and pushed through 2018. And that was when we saw the most stimulus come into China, from the end of 16 to 18. And then as the stimulus slowed, so did some of these impulses. But now they need to take some of these loans out of the market because they're just underperforming, and they need to start realizing, okay, well, what is the percentage? What is the chance of a bad debt expense? And this is why the leverage ratios are so difficult at the Chinese level and remain so elevated in general. So then when we look at the former Minister of Finance, Liu Zhihua, it's important to appreciate it came out last year, but it was published recently, because I think this speaks to the issues that we've been highlighting in our end of year report. We keep highlighting in the constantly on our shows. Is China will face mounting fiscal difficulties in the near future, as we've been talking about. Liu made the comments in December, but the speech was just made public. According to Liu, Chinese fiscal position faces pressure from the global economic slowdown, which, as obviously is very, we all know this, that's not a surprising thing, but it will also be impacted by the aging population, mounting local government debt, and the fallout from U.S. stimulus policies. So we're seeing that we keep talking about Biden talking about the 100-day plan, figuring out where those supply chains are really sitting and trying to address those issues. So Liu also said soaring government debt and global trade frictions will all create huge uncertainties and severe challenges for China's fiscal sustainability. The fiscal difficulties are not only a short-term issue, but also will be serious in the medium term. He is not optimistic, obviously. He argued that the debt sustainability of most Chinese provinces and cities would worsen between now and 2025, which is very different than what we've already heard. But this is what we continue to see when we do our own work, when we look at some of the smart people like China Beige Book and some of these others that keep highlighting these issues, and we continue to see at the trade level. So now, speaking of the trade level, China's investments in Australia continued to slow through 2020. Obviously, they peaked in 2016, but a lot of this reversed back, and we were already seeing this slowdown in general activity in Australia and other places as they looked into Africa and other parts of Asia. So Canberra introduced in March last year temporary changes to its investment framework, which subjected all overseas investments to scrutiny by its Foreign Investment Review Board. The government also forced the abandonment of 2 high-profile deals with China's Menjing $600 million bid for Japan-owned Lion Dairy and China State Construction Engineering Corp's $300 million bid for ProBuild, a South African-owned construction company. All of the pressure is going to continue with Australia, and as we said last week, India stepped in and has been buying more of Australian assets to really backstop some of those issues. So then on Sunday, just expanding on some of these issues, now that we've seen, we've talked about debt, we've talked about the Australian problems, major Chinese retail company Suning announced that its 5 largest shareholders will sell a combined 23% stake in the company to local Shenzhen's state-owned enterprises, a bailout. Shenzhen's International Holdings and Shenzhen Equity Investment Management. It reflects the fact that Suning's inability to pivot to e-commerce, so they've continued to struggle, but also the fact that overall consumption continues to lag the post-pandemic economic recovery. So they've expanded internally, and they've financed it through debt, but they haven't been able to get a return on investment because the local consumer hasn't been there, and they've been expanding for 5 years. So again, this isn't a COVID issue. This is an issue that has been going on within China over the last several years, and it's only gotten worse because of China, because of COVID and the uncertainty of the Chinese consumer, which resulted in a bailout. But when we think about the bailouts that are happening internally, you have to consider, is that why they're not investing more abroad? Because they're trying to invest more internally and trying to solidify some of these issues. So when we look at Australia's top exports to China, there's a certain percentage when you think about rebar prices and steel prices going to all-time highs or at near-term yearly highs in China. Iron ore and coal, a lot of this goes into China. How much can they really not manage with Australia? Then when we look at mutual benefits, China relies on Australia for, a big portion of some other key products, wool, iron ore, coal. This is going to become a much bigger problem over the coming few months as the trade war continues to remain. And how is China going to find other means of bringing in these goods without seeing a huge increase in cost, because their ability to subsidize some of these prices is going to be impacted. So then let's look at some of these prices. Let's look at something as simple as semiconductors. Now, some may not know, I didn't know, that semiconductors take up a huge amount of water, and that has taken even more as these layers have gotten broader, as these semiconductors have gotten more complex. And the lack of typhoons has resulted in well below average rainfall across Taiwan. This year's rainfall as a ratio of the 20-year average to 100%. So they're at about 60% of normal rainfall. So that just means that there's this less fresh water to use in the manufacturing of semiconductors. And here's just putting into perspective the amount of water that is required, which has risen over the years as the complexity or the layers have increased over time. So this is going to become a bigger issue when we think about cost, because price of water goes up when there's a shortage, and this is going to become some of that again impacting the supply chain and the underlying cost of CPU capacity, semiconductors, storage, all of these things that we've gotten very used to always getting cheaper. Now that we think about water in this aspect, well, let's think about U.S. planted acres. So you can see planted acres have gone up to essentially the highest it's been going back to 2011, with over 175 million acres planted between corn and soybeans. Again, one of the reasons why I'm so bullish in the grain side. But As the U.S. increases planted acres, Brazil is struggling, Argentina is struggling, but what is happening at the Chinese level? So taking that into perspective. So China says it will increase planted corn acres in 2021 by over 667,000 hectares in key growing regions. That's a minimum of 1.6% on the 2020 area of 41.3 million hectares. Now, total area would still be below the one planted in 2018. And it's because they don't have the capacity to plant because people have moved in on this land, because a lot of the arable land that's available is also where most of these people actually live. So if you applied the increase through to production and assumed a similar yield, China would add about 4.2 million extra tons of corn output on the year. Now, that sounds great, but we're seeing an increase in demand for feed, and we still have a growing population. Even though it's aging, they still need more food for its populace. So China's own supply and demand estimates show that 2021 corn consumption will be up 11 million tons or 3.9% on the year. So consumption's going up 11 million, feed consumption's going up. So yes, they're going to buy a lot of corn and it's going into feed, but the USDA estimates suggest that 71% of China's domestic consumption of corn is feed use. So the difference in growth is going to go to feeding their populace. And that's why but even though they're feeding more, they still need a bigger backdrop. They're still coming into the international markets, which is why the Yangtze River is so important. A big talk about in this current Congress is going to be the Yangtze River Basin. And this is a chart that we had in our Three Gorges Dam sections and episodes. You can go back and watch them, where we talk about the impacts to the flooding that really hit the area. So now they're trying to find ways to protect the region from droughts and from flooding to make sure that this doesn't happen again. But it doesn't, and none of this is going to be built over a short period of time, because not only is a lot of growing happening here, and they need to increase the growing capacity in the basin, but it also generates a huge amount of GDP. It's about 39% of the country's domestic foreign direct investment of inflows in 2018, and the Yangtze River Delta generated 20% of China's total GDP in 2018. So they need the GDP. They need the foreign investment, but they need the food. So this area is going to get a lot of focus over the next few days. So what are they looking to do in general to help solidify not only that area, but other means of interconnecting the different provinces? So think about like what those GDP numbers look like. And the plan over the next 15 years is passenger volume growth of 3.2% annually, freight transport volume up 2%, and package delivery up 6.3%. So what are they looking to do? They want to have 1 hour commutes in metropolitan areas, 2-hour transit times within major city clusters, and all domestic deliveries made within 1 day. This takes a lot of infrastructure. This is also a way that they can invest in infrastructure to bridge some of their gap and pad some of their GDP numbers. On railways alone, the plan targets extending the rail network to around 200,000 kilometers by 2035, up from 146,300 in 2020, which is about 8.5 trillion renminbi. A lot of money, a lot of spending, and this is a way to also, because as we keep talking about, there's also a push to rural connectivity. They want to focus on building out the rural community and making them a bigger part of the GDP component. And the only way you can do that is making communication and travel easier. So contrary to expectations, now this is coming from Trivium. And if you think back to what we're showing right now with the Yangtze River Basin, what does this mean? Well, contrary to expectations, China's exports boomed in 2020 as foreign countries scrambled to buy PPE. That won't be happening the same way in 2021. PPE is being made everywhere. Everybody can, if you want a mask, you can get a mask. If you want a protective suit, you can get one. So you're not going to see the same bump. So they need a way to close that gap. And officials are concerned. Again, this is why we keep talking about supply versus demand and what is that demand going to be versus the supply in general. and there's not much they can do about it. But what's more, they will be more competition as other exporting nations start to recover. Again, Taiwan, Vietnam, Australia, India are getting back on their feet, and there's going to be a big impact to how China can compete. So let's just think about now, this again coming from the Three Gorges Dam, this is what that delta looks like and those flood zones. They need to come up with a way to mitigate these flood zones and or manage them to garner some of the additional water, increase the planting zones, and try to increase this total throughput of grains to try to mitigate some of the demand that they have in the international markets. This does not happen overnight. It will be very expensive. It will take time. And that's why the purchasing in the market will remain robust over the next few months, the next few years. So now what is the law that's going to take effect and is going to be talked about coming up? Yangtze River Protection Law takes effect. So on Monday, the Yangtze River Protection Law passed by the National People's Congress in December, and it's why it's going to be talked about again on March 5th. It's the first law protecting a specific waterway because it's so vital to everything we've just been saying. What does it aim to do? Strengthen the ecological and environmental protection and restoration of the Yangtze River Basin, promote the rational and efficient use of resources, safeguard ecological security, ensure harmony between mankind and nature, achieve sustainable development. What does this mean? It means that they want to take what they have, they want to protect from flooding because the drought, the flooding that happened destroyed huge amounts of crops that is now leaving them net short in the market and out there buying as much as they can. And that takes time. And that's why there's going to continue to be this bid in the commodity segment. But there's also a movement of how do they connect some of these raw materials in the region to these demand centers, because they're trying to rely less on Australia and less on external markets to have that dual circulation strategy. So these are going to be a lot of components that are going to continue to come up in the Congress starting on the 5th. So I know we covered a lot. I know that we continue to do that. We have more coming out on Friday with the primary vision Frac Spread Count. We'll go through OPEC in a bit more detail, but this is some of that prelude to what are they going to talk about in the Congress. A lot of this is a rubber stamp. You've heard it before from us by reading in general, and then we're going to talk about when it's official and the transcript comes out. What does this mean going forward? Because there's going to be a lot of commentary coming from both China and the U.S. As we said yesterday, as we said last week, that U.S.-China trade war, Cold War friction isn't going away anytime soon, and each side is gearing up with allies, and China's struggled with theirs, and the U.S. is trying to rebuild some of those relationships and strengthen them in the near term. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.